now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition of The Real Investment Show. It's the second best day of the week. That's right, because weekend's right around. Everybody right now suffering from PTSD, of course. I actually had a guy yesterday, though, seriously, you know, look, I know there's cold weather coming, and I know we're all having flashbacks to, 2021, where we're all frozen in, broken water pipes, all this type of stuff. But I had I've got a problem with our pool, and I had the pool guy was supposed to come out yesterday, and it's 69 degrees outside. It's a little overcast, right?
Yeah.
69 degrees.
February.
It's February. He calls me up and says, I can't come out today because of inclement weather. Now,
what's this guy do for a living?
Works outside. Just say. But no, I actually get a call from the pool company go, we can't come out today, inclement weather. Look, I know it's cold, right? It's 39 degrees outside this morning.
Your mic has died.
Oh, okay, well.
Why don't you step over here?
Yeah.
We'll do a couple of things. Camera one. And
it's all right.
There we go.
There we go. So anyway, I things don't always work. So see, inclement weather, my mic has decided not to work this morning. But that's the whole funny thing is that, this was an issue of, we're all just having PTSD now. It's like we got cold weather. Look, I get it, right? We got cold weather coming. Lots of people concerned that this is going to be the next great Arctic blast from the ice age, and we're all about to be, stuck back in, to houses for a week. Look, I get it, right? But, let's not overreact to these things.
I want to know, what are the ERCOT odds of success or failure?
50-50 at this point. Yeah. We'll see. No, I think they're much better prepared this time around. So,
yeah,
I think we'll see. But, it's just interesting. Again, this is kind of the PTSD moment. If you lived here in Houston after Harvey, it was kind of the same thing for the next couple of years. Every time we had heavy rains, we all had flashbacks to Hurricane Harvey and the flooding and all this type of stuff. So I get it, right? I get it. I thought it was funny though, because the weather was fine yesterday afternoon. There was no reason you couldn't come out.
Hey,
solve my problem.
Yesterday afternoon, the commute home, top down, baby.
I know. It's great. A little overcast, but nice day. Yeah.
No sunburn.
Exactly. No melanoma. It was a no melanoma Thursday.
Wednesday.
That's true. So, speaking of melanomas, Facebook reported earnings yesterday.
Smooth.
Nice. Like that transition? Yeah, it's more than just Faceflop yesterday on earnings for Facebook. And again, is this really surprising? Stock's going to open down about 70 points this morning, somewhere around $250 a share. That's going to put it back to the lowest level it's been at really since March of 2020. But the question is really, does this surprise anybody? First of all, Facebook has a huge demographic time bomb. The only, if you ask your kids if they use Facebook. That's all you got to ask, right? Just ask the next generation down from you, do they use Facebook? The only people that use Facebook are basically old people and robots. That's it.
And the robots are winning.
The bot farms are winning. And that's really kind of the sad news for Facebook, is that they couldn't create enough bots over the last quarter to keep their monthly average users up. So, But again, this is just kind of really one of the longer term problems. What's the real value of Facebook ultimately? Probably closer to zero, because once the older age generation dies off, unless they can pivot and pick up on the next TikTok, and this has always been the problem with these social platforms, is that they're great, and for a while they seem to have a perfect moat. Nobody could invade that kind of moat of that social media. Facebook had it all tied up. They were so big that nobody could compete with them. And then Instagram came along. And then they bought Instagram, to pull it into their fold, which was probably a smart move at the time. Instagram still has, a lot of activity with the younger group, which is good. So then Twitter came along, and then TikTok. And there are more people now using TikTok than just about anything else at the moment. But again, this is always kind of the risk with the social media platforms, is that they've got it going until somebody comes along with something newer and cooler that everybody migrates over to. And there's no real loyalty ultimately to a platform. I can just uninstall it or install it or not go to it. And there's a lot of people that have Facebook accounts that never use them, right? So yeah, they're counted as a user, but they're not necessarily active. And then of course the other side of this, as I just said, is that a lot of these users are just basically bots. So, the question, and it was interesting, they were talking about, yesterday, the Washington Commanders. We've got Michael Lebowitz joining us this morning. We'll touch on this, but he and I were talking about this yesterday, is that the Washington Commanders, now this was the team that was formerly known as the Washington Redskins.
Wrong color.
Then they changed it to the Washington football team. And for some reason, they had some great names. They had the Washington Red Wolves. I thought that was a great name, right? I thought that was going to be one of the names they would surely pick. It sounds ferocious, right? Commanders. Yeah, it was met with a inherent shrug by most of the members. But interestingly enough, their social media account, the day within an hour of them announcing their name, Washington Commanders, the Washington Commanders page had over 1 million followers. That's because they just bought them, right? And that's the whole issue with a lot of these companies, is there's so much stuff that goes on behind the scenes. When you actually take a look at these metrics that we use to value these companies, we don't really value the company as much on revenue growth and earnings growth. We do look at those, but we use these kind of weird metrics like monthly average users. Well, if I've got a lot of bots that are using, that are just logging into the page, they get counted as monthly average users. How many actual users do you have, right? That's the real question. How many live actual people do you have using your platform? That's really the question. But as I said, one of the things that is potentially problematic for all of these platforms. And just one thing to remember is that, there is no long-term loyalty to these. Again, when somebody comes up with a cooler, newer thing, everybody will just migrate to something else. And, that's potentially problematic. And again, we're going to see this kind of reverberate through a lot of these companies. We're going to see this kind of happen with companies like Pinterest, Snapchat, Spotify, all these companies, because there's so many, there really is no barrier to entry other than money. And if Mike and I wanted to set up a Twitter-like platform, we could do that. All we could do is hire a programmer, put it up and running, and that's it. Now, whether or not we can go buy users to come use it, that's a different question. But, there's really no barrier to entry in creating these platforms and creating these opportunities. And it's always just been a functional question of how long was it going to be before it caught up with Facebook and the competition would start to eat into their platform. And that's what you're now seeing happen as more and more of these competitive platforms like TikTok, do rise to fame and popularity. All right, be back from the break. Pick up with Michael Lebowitz. And of course, we got a lot of stuff to get into this morning about the markets. Is this recent rally just a rally within a bear market, or is it the return of the bull? We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Which camera are you on? Okay. So your camera is frozen?
So right now we're playing radio. You really can't see us, but you can hear us. Just go ahead with Michael, and I'll work behind the scenes.
There you go. So you're just having a Groundhog Day with technical equipment this morning.
You have no idea what I went through yesterday.
I can only imagine.
Yeah, I mean, it was stark.
Yeah, there you go. Yeah, speaking of that, Puxahoney Phil did see a shadow yesterday. So,
Yes.
Again, that's why we have now 39-degree weather in Houston.
And did you see where one of his competitors knocked the bucket off yesterday?
Uh-huh.
Yep.
So, yeah, so anyway, 6 more months of winter. Six more months. Ice Age. 6 more weeks of winter, unfortunately, and that doesn't bode well for Michael Lebowitz. He's joining them this morning. Michael, really? Washington Commanders, that's the best you guys could come up with?
Can we talk about your weather first?
Yeah, sure.
I'm tired of, it may ice, it may get to the 30s. Up here in the Northeast, we literally have had about 4 days where it's been above freezing in the last month.
Yeah. See, I know that's what I'm saying is everybody's got PTSD down here from the last year when we actually had a freeze,
Right.
And now as soon as it gets look, and if you ever come to Texas, this is the funniest thing is that if it drizzles, people can't drive, and if it snows here, the whole world come. I mean, like if you just get a snowflake, we shut down everything. I mean, schools are shut down, roads are shut down. We kind of overreact to bad weather here, so. Yeah,
right.
It's not surprising.
Right.
So back to my bigger question, though, really. Washington Commanders, really? That's all you could come up with out of all the possible names?
A, it's awful, and B, I didn't come up with it. It wasn't my choice.
I mean, y'all had some good names in the mix. Like I was saying, Washington Red Wolves. I mean, that sounded good to me.
I was a big fan of the Red Hogs.
Yeah.
If you remember back in the 80s and 90s, the line was called the Hogs.
Right.
So at least there's some history, and it's not going to offend too many people.
Well, it would offend the Hawks. That's the
Right.
problem. It would be discreet. Right. I mean, that's what got y'all into this whole mess to start with was the whole we need to be worried about hurting somebody's feelings. And I actually interviewed. What was interesting, they actually went and took a poll of the Indian nations, and they go, we don't care.
Right. It actually got support from a large majority of them.
Exactly. So anyway. That's what you get for falling prey to the whole social media thing.
The team hasn't been good in 30 years. It's not the trend. It's been in a bear market for 30 years, Lance. What do you want me to do?
I know. That was actually one of the funniest things that I saw actually printed yesterday about the Washington Commanders is that they spent a year and a half coming up with the name. And and it's like, well, now you can get on to, to less important things than the name, like, winning a game would be the next thing.
Honestly, right? It may be better off as management is focused on a name instead of players and personnel and football.
Yeah, true. Anyway, all right. Well, a couple of things, like I said, we're just kind of hitting on this morning. Faceflop this morning, certainly going to impact the market. So, we had a kind of a fairly strong reflexive rally here, something that, we've kind of been talking about. Markets have gotten extremely oversold here. Lots of negative. If you take a look at, for instance, sentiment indicators across the board got extremely negative. The CNN fear greed index got into I just don't care anymore territory. And, so not surprisingly here, we had a fairly strong reflexive rally here over the last few days and started approaching the 50-day moving average. Now, interestingly enough, the leaders of the index, the generals, Apple, Microsoft, Google, and then, of course, that you throw Facebook into that bucket. Everybody was creaming earnings. Apple, Microsoft, Google just knocked the cover off the ball in terms of earnings. And then here comes Facebook. He's kind of like that. I don't know. It's that kind of weird kid that always shows up at the parties late, right? I mean, here comes Facebook and says, "Hey, let me spoil the whole party," and just completely misses earnings across the board. I mean, it's a really bad report. And Outlook was even worse for it. And that stock's going to bring the whole market down because of its market cap weighting size. It's going to bring the whole market down this morning, fairly sharply. We'll be down over 1% on the NASDAQ, mostly due to Facebook. So, this is all, what's good about these big cap companies on the way up is that they can kind of support the index. Unfortunately, they also kind of hurt the index when they stumble and fall over. And that's what's happening here. What are your thoughts?
Well, that's been somewhat of a theme this whole earnings season, that when companies miss, it's pretty ugly, uglier than I kind of remember it being in prior quarters. Mm-hmm. And, we saw with Netflix. Netflix was also down, 25%. Yep. Twitter's down a lot this morning. Spotify down a lot because of earnings. And there's a few other companies. So the message, I think, is that valuations are so high that you better get your earnings right. If you're paying a heavy price for something, just like when you go to a store, when you pay a lot of money, you expect for the product to be right. You expect for it to be what you want, to look what you want. And these companies are coming in, Facebook's earnings weren't good, but we've seen some companies come in with decent earnings. Mm-hmm. Maybe they missed by a penny here, they beat revenue by a little bit, but they warned that forward earnings will not be as good as expected, and you're losing 10, 15, 20%.
Well, Netflix was a good example of that. I mean, their earnings weren't their trailing earnings weren't terrible, right? But it was their forward guidance that really, I think most people should have expected. When everybody was locked up in their house, they signed up for Netflix because they had nothing else to do and there was nothing else on television to watch. And once you run through everything on Hulu, you got to go find somebody else that's got something. It surprised me to the degree that Netflix fell because, again, you should have kind of expected slower subscriber growth now that everybody's going back to work and getting out of the house, right?
Well, yes. A lot of these things, though, like Netflix just raised their price as well. Mm-hmm. Right? It's not cheap anymore. Would they raise it to $15.99 or $17.99?
Yeah, well, that's if you have the premium service.
I think the premium's like 21.
Well, there's three levels, right? So in my household, we have the basic level, which is $9.99. It's like you get one screen and it's just what you get. I mean, then you get the HD and two screens. I think it's $15.99. Then you're right. Their full service is like $21 a month.
No, but I think they're slowly rolling out the $15.99 or whatever it is to everyone because we just got hit with that, and we're on the basic too.
I gotcha.
So it's coming to Texas soon.
Right after the freeze.
But, the
Netflix
problem
rates
is,
going up.
It's Hulu, it's HBO, Paramount. I mean, how many services do you need on top of cable? Right? It's in my circumstance, at least, I'm paying them, way too much for cable.
Right.
And, it's getting harder and harder to justify. So you start cutting services, right? You either cut cable or you cut services. And I think over the next couple of years, we're going to see a lot of people trying to figure out how to do this all on the internet, cut the cable cord, or just stick with the cable and try to cut it down to maybe one or two services.
Well, I think that's, this kind of goes back to, we've talked about this before in the past, is that, look, you've got to have, in order to have high-speed internet, right, you pretty much need cable. And there's other services, I'm not saying, but if you want high-speed internet, you're going to call Comcast or Verizon like that to deliver high-speed internet to your house. So you're paying the internet bill already, and then you lay on the video services on top of that. And the purpose initially of all these services was that you could unbundle all this, right? You could just pick the service you want, you could pay for it. Well, that's all, and we talked about this before. It's like that's all great, fine, and dandy until you've got 10 services that you're subscribing to, which is now costing you more than cable.
Right.
And so it'll be interesting. So I think the interesting thing will be is if we go back to bundling again to get cheaper services, right? Does Netflix start, and again, does Netflix start to bundle with, hey, if you subscribe to Netflix, you can also get access to Hulu and, a couple other services. It'll be interesting to see if they start to move back to that to retain subscribers, start cutting deals to bundle services into one monthly fee, because people are getting feed to death. This is going to be the same problem, I think, on the internet with the New York Times, the Wall Street Journal, Bloomberg. Everybody's going to these paywalls for information, and if you want to have access to good quality information, those fees are starting to rack up, and if you make a lot of money and you have a lot of discretionary income, hey, it's probably no problem. But for the average American, it's starting to get expensive.
Right. And I think when you're going back to Netflix 1 second, I think what we're starting to see is the evolution of what they do or how they do it, right?
Mm-hmm. Right.
It's not just everyone just subscribes to Netflix and that's it. You've gone through all those people, right? Now you got a lot of competition, and you're going to, like you said, you're going to have to come up with bundling. You're going to have to come up with special deals. And they've gotten all the easy money, the low-hanging fruit, right? That's what makes Netflix a little tougher going forward, is that they're going to have to somehow add to their service or cut prices or something to make it more enticing. Yeah. Or just keep producing great shows, but that's really hard to do for years.
Well, and I was going to say that, I was just about to say that is, content is also becoming a bigger problem, because to produce, there's a lot of shows on Netflix and other channels that you look at them and you go, this was kind of just thrown together, wasn't it? There's, but I mean, every now and then, they come out with a really good series or whatever it is. But, producing really great content is not something you can do on a cookie cutter type mill and just keep rolling that stuff out every month. It takes a lot of time to do that, and it's very expensive. And the problem is once you run through the content, it's getting more and more challenging to keep subscribers longer, particularly now when I can just unsubscribe and then resubscribe later, under a different Gmail account and get a free month and those type of things, right? So I think the whole model is going to, the evolution of that model over the next few years is going to be really interesting to watch. Okay, quick break. We'll come back. Is this market rally over, or is it just getting started? More on that with Michael Lebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
They surveyed Americans asking how many guns do you own? 29% of the country owns 5 or more guns. So I tweeted this out. I said, I'm obviously in the 29% camp. So I got a tweet back, obviously from a non-gun owner, that says, I don't understand why you have to have so many guns. I've got coyotes behind my house. I've got copperheads.
The Real Investment Show podcast. Same show, your schedule.
And I'm not going to stand out there with a 9mm trying to shoot a copperhead.
At realinvestmentadvice.com.
It just ain't going to happen.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn. Thursday, February 10th. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So markets are going to open down rather sharply this morning. Nasdaq's going to be down about 335 points right now. S&P will be down less than that. It'll be down about 50 points this morning. Dow will be down about 50 points as well. This is almost all entirely due to Facebook. And, below that surface will be all of the related companies that either have reported or basically kind of, simulate in some form the Facebook type platform, like Twitter, like Snapchat, others. Those are going to be down as well, just in sympathy more than anything else. Concerns over whether or not their user base will be declining as well. But, look, right now the Dow is only about 3.5% below the all-time high. The S&P is down about 4.5% from its all-time high. The NASDAQ had a 7.5% rally over the last few days from the lows. So, already, a lot of that that damage that was caused and the kind of the sell-off at the beginning of this year that everybody was panicking over, we got down to almost 10%. Now has recovered a big chunk of that. And the question is are we back into the bullish trend, or is this just a reflexive rally within a bear market where you're going to have more downside to go? And what's interesting here is something that we talked about multiple times last year, is that we were in a year last year where we had very low volatility. We were down about 5% at the most a couple of times in the year, and that was about it. And we said more than once that when we got a 10% correction, it was going to feel a lot worse than it did because we hadn't had one. And sure enough, as soon as we got a 10% correction, the fear, greed, sentiment gauges, just pegged out to the floor on the fear side. The American Association of Individual Investors, their bearish indicators just went right through the roof. Everybody just got super bearish. And of course, across the media is just, massive amounts of headlines about, the bear market's here, the world's over, this type of thing. And so that led a lot of people, we've gotten a tremendous amount of questions and comments like, this is a bear market, and is the market about to crash 50%? Jeremy Grantham out, with his article, the 50% crash is here. Maybe not. I don't know. That's the big question. And then, of course, how do you navigate this, whether it is or whether it isn't? How do you navigate this going forward? And this is the big question that Mike and I struggle with every day, right? How do we, work through a correction, which is all we had, right? The market was corrected by 10%. We held support. Market rallied off of it. Or, if this is a bigger bear market, how do you navigate that? And there's some certain reasons to be, concerned that we may have more trouble with markets ahead. And that's, where we'll start. Let me flip that over to Mike real quick because he's my local bear. Hey, Mike, why is this market about to have a 50% crash?
I'm not calling for a 50% crash. What I think, though, is important, the words "don't fight the Fed," right? Typically, "don't fight the Fed" means just buy. It doesn't matter what you're buying, what the valuation is, because the Fed is doing QE. They're lowering rates. They're actively promoting. They're actually pushing. They're pushing liquidity into markets directly or indirectly. We can debate that all day, but they're supporting markets via monetary policy. Don't fight the Fed, you buy. Don't fight the Fed also means be careful. Right now, they're not starting. They still got their foot on the gas pedal a little bit, but they're telling us that they're going to take their foot off the gas and eventually hit the brakes. So, we're kind of in this period where the Fed is still liquefying markets, but telling you that they're going to be deliquefying markets in the future. So don't fight the Fed in an environment where they're raising rates, where they're taking away QE, doing QT, reducing their balance sheet, means that you got to be careful chasing the market. You got to be very much more defensive. So we're in this in-between period. We're watching what other central bankers are doing. Will the Fed follow? That was kind of my gist of my article that I put out yesterday, was dissecting what Jerome Powell just told us, because he was to some degree all over the map.
Right.
Inflation is scaring them to death. Is it scaring them enough to take the stock market down 20%, 10%, 15%? In the past, we've seen the Fed come to the rescue of the market when it's down. 20% for sure they've come to the market, but even down 10 or 15, the tone starts changing. They start saying things that are a little more productive towards the markets, towards monetary policy. Is inflation enough of a bugaboo that they are willing to sacrifice 20% or 30% or even more to tame inflation? Inflation can be a big problem. Will it last? Don't know. The Fed has been wrong on inflation for a while now. They're finally coming around to see that's a little more persistent than the transitory inflation they thought. So, each month we keep getting inflation that's either persistent at where we're at 7%, or trending higher. It puts the Fed in a deeper and deeper hole where they're going to have to react more aggressively. And how aggressively will they act, and how much will asset prices factor into that, and the economy unfortunately to a lesser degree. It should be to a more degree, but
the Fed's going to face a really tough problem here fairly shortly, though. If you take a look at ISM manufacturing indexes, ISM services indexes, look at prices paid, all those are starting to show that inflation on a lot of levels has peaked now and has already started to decline. The monthly rate of change in inflation has been slowing for the last 3 months. There's a real risk here. The Fed's late to the game, and they're going to start hiking into into a weakening economy. If you take a look at the yield curve, it's already telling you that the economy is slowing down rather sharply. Atlanta Fed just printed a 0.1 estimate for first quarter GDP growth. Maybe that's too low. Maybe that'll come up here a bit over the next few weeks. But there's a lot of indications that economic growth is slowing pretty sharply. And the Fed starts hiking here, they could certainly wind up in kind of being on the wrong side of the curve again. Hiking rates into a environment.
Right, and the Fed knows it. Look, the Fed's juggling a bunch of balls here.
Mm-hmm.
They know the economy is slowing down. They're looking at the data. Their data can be tough though, right? We just got off the holiday season with COVID, with Omicron. There's a lot of one-time type factors that are really screwing around with these numbers. We saw that with the ADP jobs report yesterday.
Right. Showed
300,000 jobs were lost. Most likely tomorrow's big number, the BLS number, is going to show either flat growth or negative growth. The what's her name, Psaki, Biden's press secretary, warned that it's going to be a bad employment number.
Right.
But you have weird seasonals because of COVID and the holidays. Omicron certainly had some effect on employment, and weather is always a problem in January. Mm-hmm. And it's been a cold, snowy winter for the rest of the country besides Texas. So there's a lot to juggle. If they really were very confident that inflation would be coming down sharply come March, April, May, June, they'd probably be trying to stall this out and not be as hawkish as they are. But I think they've been proving wrong long enough that they're starting to err on the side of more hawkishness. Now, whether they actually go ahead and do it or they're just talking to talk is what we don't know. That's what we will figure out over time. There's also political pressure, right? He's up Powell's up for renomination right now. And we know that Biden put him in that position. So clearly, maybe not clearly, but there was obviously a discussion by Biden to Powell that says, if you're going to be renominated, you are going to fight inflation. As he goes through the renomination process, there's going to be a lot of congressional, the House and Senate that are going to be saying the same thing, that you are going to fight inflation.
Yeah, I think there's more to this story that we're not talking about, which is the fact that the Fed's at zero interest rates, period. Mm-hmm. And you've got inflation, great, no problem. And let's assume that inflation is transient, and we've already seen the peak in inflation. Liquidity is now out of the system for the most part, so all that liquidity push on the durable goods side, that's already deflating rather rapidly. Take a look at some of the durable goods numbers coming out lately, telling you that those prices are going to be coming down sharply, but the Fed's still stuck at zero. And the biggest problem for the Fed, and to your point about whether or not they support the markets or do they try to hike rates. The problem is being stuck at zero, because if we do have a deflationary, recessionary environment over the course of the next 12 months, and if the Atlanta Fed is even close to being right, if the yield curve is telling us what it's telling us, suggests that we could be seeing much weaker economic growth over the next few months, then the Fed's stuck at zero again. So the Fed's almost in a position where they have to hike rates. It's almost the lesser of two evils. I hike rates and I trash the stock market by 20 or 30%. As long as we don't create a credit problem and as long as we don't bust margin debt, then I can let the markets decline. Now, once you start to bust the margin debt levels and start having margin calls and those type of things, the Fed's going to have to come in and start to bail out the banks. That'll just be where they've got to act. But they've got to get off of zero, because if they're caught in a recession and they're at zero, the only real tool they have to help support economic growth of any sort is really dropping rates back to zero. If they're at zero, they've got nowhere to go. QE doesn't really help, create economic growth. It does help support the markets, and then theory, psychologically, it supports markets. People with money go invest capital into the markets. It sounds great. In theory, that boosts the confidence of the consumer. They run out and buy stuff, but they don't have any money. Which is why we had to give them a whole bunch of liquidity last time to get the economy going. So I think the real threat here is that the Fed's just caught at zero, and they've got to get off of zero at some point. And if you're not at 1% by the time you hit the next recession, you've got nothing to fight it with. Be right back after the break. We'll talk about that some more with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Of course, I'm your host, Lance Roberts. Mike Lebowitz joining me. So, talking a little bit about, the markets and, is the current rally just a return of the bear market or the bull market, or is there further bear market correction to come? This is the big question. It's interesting. So I was just talking about for the break and posing this idea is that, look, the Fed's got to hike rates to get off of zero. Recession is coming. There's take a look at the yield curve. The yield curve is dropping sharply. That's pre-recessionary. If you take a look at recessionary indicators, JP Morgan's recession indicators already risen to 18% this year. To have a recession within this year is already up to 18%. Now, it's not high, but it begins to ratchet up fairly quickly as more economic data comes in. So if we if we have weak employment numbers and those start to persist, if we see weaker economic growth persist, that's all going to start to jack up those recessionary indicators. Global monetary liquidity is tightening rather sharply. We're now back to pre-COVID levels on monetary tightening, and Bank of England and others are talking about hiking rates, reducing more of that liquidity to the markets. That's all going to potentially start to push, the economy towards a recession. And if you take a look at Chase's consumer spending, that's back to has dropped. We had this massive surge in spending, and not surprisingly, because all that liquidity is now out of the system, spending is starting to roll over. Disposable personal incomes will be negative by almost 30% on a year-over-year basis in this next month. So we're seeing a lot of those early recessionary signs, and the Fed is aware of these, and they're watching these closely. And again, if they're caught at zero, that's the biggest risk for them because they've got no policy tools to work with. And that does put the markets at risk, to Mike's point. So, Mike, your thoughts here.
Well, let's go back pre-COVID, right? 2019. Everyone seems to forget economic growth was slowing pretty rapidly in 2019, right? The yield curve inverted. That's a sign of a pending recession. And the Fed had lowered rates 3 times, and they were doing some kind of QE with Treasury bills, right? So that's the starting point. Then we had this massive influx of money via fiscal stimulus, checks, all kinds of $5 trillion of stimulus in a year. That's more than 2 times what we've seen in the past. And the Fed go bonkers with QE and dropping rates immediately to zero. So we're coming out of that. those all become headwinds, and now we're looking at the reality, which was 2017, 2018, 2019, long-term economic trends.
Right.
So you start looking at demographics, which do not bode well for the economy for the next 10 or 15 years. It just is what it is. You're looking at productivity growth, which has been trending lower for 20 years now. Right? You're looking at debt levels, which are much higher today than they were before COVID started. Those are all either less of a tailwind. Demographics are still helping us, but less and less every day. Productivity growth is still helping us, but less and less every day. And you have more debt now. And you got an inflation problem now. So you kind of put all this together, and you have to start just erasing 2020, 2021 and looking at the prior trends in the prior past.
Right.
And look, the Fed's forecast for economic growth is 1.6 to 1.9%. We're not telling them something they don't know.
Right.
And when we think about long-term trends, that sounds about right. That's about where productivity growth is. So that's the reality. And that's, we don't go there. Economies just don't go in straight lines. They zigzag, right? So you couldn't get 3% growth and you get minus 2% growth.
Well, and so that really comes back to this whole question here then is, we've had this nice rally over the last few days, are we, and this is the question everybody wants to know, right, is are we approaching a bear market where, markets are going to be down 30, there's a lot of stuff running around the markets right now. 50% crash, the whole paradigm is over, better be in gold and cash. And, that's a very tough, thing to do, because once you go in that direction, if this market, if the Fed comes back in tomorrow and says, hey, you know what, we were just joking, there's a probability here the Fed's a one rate hike and done type deal. They hike rates once, everything goes bonkers, and they're going to have to stop hiking rates. So, and there's a reasonable risk of that. The question though becomes is, trying to get off of this, super negative positioning of being in a bunker back into the financial markets. This is the biggest mistake that investors make. So how do you navigate that, in your opinion?
Well, I think the biggest problem is that markets are up, 95% of the time? 95% of the time you're in a bull market. So the benefit of the doubt goes to the bull market, to the upward trend. But it's those 5-10% of the periods where you get sharp, swift declines. And that's where you need to preserve your wealth. So, we're at a point in time where the odds of a bear market are certainly higher than they have been for a little while. But, we have to rely on all the fundamental things we just went through, all the trends. But we also have to rely on our models and our technicals and our risk analysis and our risk protocols. And when do we sell? When do we see signs that the market may be rolling over? When do we see signs that the market is bouncing? And what we saw was a little emotional and nothing more than a little stumble on the way higher.
Right.
And that's where you got to rely less on gut and rely more on everything out there and putting it together into a plan. But you have to have comfort with that plan by having risk levels in mind, by knowing where, I'm going to pull the plug at this level, or, we're going to buy at that level because that signals that we're going higher. And it's not easy, and you got to strip out your biases, because there's a lot of psychological things that get you to either hide in a bunker or to just buy everything because it's 20% off. Right. And, you're going to miss out on the next great bull market rally. And, and a lot of times we have both of those, but, kind of bombarding us, and managing through those biases and managing through greed and fear is really difficult. But again, it's focusing on fundamentals, focusing on technicals, focusing on our models, what the models are telling us, and adjusting along the way. And look, we're not going to be right. No one's going to be right. But it's managing the risk and managing the upside, and taking in data. There's data every day. This morning, as we're talking, the Bank of England raised rates 50 basis points, 0.5%. That was kind of shocking news. So what does that mean? Does that make it easier for the Fed to go? Does that make it harder? How does that affect global liquidity? What about the dollar?
Well, and this is what I was talking about, before, is that monetary policy worldwide is tightening, not just in the U.S.
Right.
Yeah.
Right. But these are all factors and they crop up all the time. I mean, right now, there's one Fed speaker after another telling us their thoughts on monetary policy, on what we should and shouldn't do. Some of them are very hawkish, right? We've heard calls from some of them for 50 basis points. Others, like Neil Kashkari, is like, maybe we'll do one and then we'll stop for a while, right? And they all have a vote, right? Powell is the head guy, but they all have a vote and they all have a say, and they can all upset markets or help markets regardless of how minimal their vote may be. And these are all the factors that go into what we have to deal with minute to minute almost.
Wow. And again, this is where it comes down to also selection of assets as well. When where should you have assets? I mean, this is, and again, I think this week has been a prime example of that. If you owned Apple, Microsoft, Google, those companies have been killing it on earnings. They've been performing very well. Your portfolio's has been held up by that. AMD had great earnings yesterday. Out of all the sectors in the markets right now, only 2 sectors actually have profit margins that are higher than they were higher in quarter 4 than they were in quarter 3, and that's technology and energy. Outside of that, everybody else has shrinking margins. Not surprising because of inflation, but because tech is so big in terms of and versus energy, which is a very small relative weight in the overall index. Because technology is so big and their profits are so big, it makes the whole profit metric looks like it's in much better shape. And really below the surface, there is weakness already occurring because of higher rates of inflation, higher input cost, higher wages. So stock selection is going to be really important. Buying good quality fundamental earnings, companies that have good, strong earnings, dividend growth. They have the ability to weather slower economic environments and disinflationary environments as well by creating earnings growth. So really focusing, where you've got money allocated in your portfolio is going to be, and really that selection process is going to be just as important as trying to figure out if the market's going up or down.
And look, the Russell 2000 small caps who can't pass on inflation, who don't have the benefits of the Apples and the Microsofts of the world,
stock buybacks, borrowing dirt cheap. They can still borrow cheap, but not dirt cheap. They were in a bear market earlier this week. They've rallied out of it since then, but they were down over 20% from their highs. Yesterday, when the market was up a lot, Russell was down. So again, it's stock selection, it's sector selection, asset selection, right? Being in safer as far as earnings, being, price skewing a little bit more towards value versus growth. But, companies, some of these companies like Facebook, look, their earnings are still growing. They're now trading at a PE below 20. So, you can think of Facebook, like it or not like the company, but all of a sudden it's starting to get into the value realm. So some of these companies that are really beat up, again, focus on the company, not the stock price. And look, we've got an interesting chart out in our daily commentary. It'll be out at 7:30 this morning. But looking at the Russell 2500, which is really kind of the proxy for small and mid caps, and it is near a record level of companies that have negative earnings growth, which is very unusual for the index. So again, just something, there's a lot, again, quality of what you're paying for is very important to help you minimize damage to the portfolio. Because look, if the entire market falls, that doesn't mean every individual stock or every sector will fall relative to that as well. So part of building support and hedge in your portfolio is asset and equity selection. We'll have more on this in the next few days, of course. Also, read our weekly newsletter. It'll be out this weekend, talking specifically a lot about this and more. Go by our website, realinvestmentadvice.com. Get our latest blog posts, videos, more, all there for you, realinvestmentadvice.com. We'll see you back here tomorrow, the next edition of The Real Investment Show.
It's a rich man.